What's going on, guys? Matthew Muniz here. Welcome back to the channel. The passions are family, fitness, and finance. And in today's video, we're going to compare two popular income ETFs that pay monthly dividends, QYLD and RYLD. We're going to look at their historical performance. We're going to see which one's been performing better recently in terms of dividends and capital appreciation, if any. And then we're going to look at using margin to invest in these to generate additional monthly cash flow to help us pay for whatever it is we need. These are two fantastic ETFs that can play a specific role in someone's portfolio when it comes to their overall investing goals. So first things first, I am not a financial advisor. This video is for entertainment purposes only. We're going to talk about the two funds, we're going to look at their performance, we're going to forecast out future performance, and then we're going to determine what the best options are. Now remember, past results do not guarantee future results. So this is all theoretical. And lastly, my YouTube channel is pretty new. Only 5% of my total views come from subscribers, so 95% of the people viewing my content are not subscribed. If you like making passive income, you work hard for your money, and you want it to go further, feel free to hit the like button down below, subscribe, turn on notifications. I will be posting videos every Thursday at 3:15 p.m. Eastern Time. So let's get right into the video. Okay, so first things first, we're going to compare RYLD or RYLD to QYLD or QYLD. QYLD is the much more popular and well-known income ETF currently. However, RYLD has actually had a fantastic year this year with significant capital appreciation and dividend growth, which is making people to start to look at RYLD instead of QYLD. So when it comes down to it, both funds are actually very similar. They follow an index where RYLD follows the Russell 2000 and QYLD follows the NASDAQ 100. Both of these funds sell covered call options on a monthly basis to generate income. That income is then distributed out to the shareholders on a monthly basis. Now, both of these funds have a 0.6% expense ratio with an investment of $10,000, that is $60. And the reason for such a high expense ratio is because you're paying for the service of the covered call options that are being written. So that saves you time, and everyone knows time is money. So a couple things to keep in mind is that QYLD came out in 2013, so it's just less than 8 years old, whereas RYLD came out in 2019, so it's a lot newer. The reason that this is important is because when we look at the historical data and we want to forecast out future results of our investments by using averages, we have a lot more information when it comes to QYLD versus RYLD. RYLD is only a little bit older than 2 years, so there's not much information, and also significant dips like in March of 2020 can skew our results a little bit. So now we're going to look at the historical performance of just the price of the asset for QYLD versus RYLD. So we are not reinvesting any dividends, we're just looking at capital appreciation. Now, looking at the 1 year, it looks like RYLD is significantly better. The price consistently goes up over the entire year. However, when we go to the 5 year, we see the blue line a lot longer. That's just because QYLD's been around a lot longer. However, look at these dips. So this was during the March 2020 COVID pandemic, and RYLD dropped almost twice as much compared to QYLD. So RYLD is showing that it's a lot more volatile compared to QYLD. Now, past results don't guarantee future results. However, when you compare large cap stocks to small cap stocks, this kind of trend makes sense. So if we're just looking at 1 year history and we're looking just for price appreciation, RYLD is definitely hands down the winner. However, just don't forget that it looks like the price is a lot more volatile than QYLD's. But the bottom line is, when we're investing in these ETFs, we actually don't really care too much about price appreciation or price decay. What we're looking for is consistent price, and then what we really care about are the actual dividends. So I absolutely love Excel and I love analyzing numbers. So I've made a spreadsheet that compares QYLD and RYLD, and we can put in an initial investment. Now we'll change it to $10,000, although we can put in whatever we wanted. We're going to put in that $10,000. We have our initial market value. And then 10 years later, what is our market value going to be if we had reinvested all of our dividends? So in this chart, we use the actual history of QYLD for the first 5 years, from 2016 all the way up until July 2021. RYLD, we had to take an average price. And the reason for that is the fund wasn't around in July. So we took the average price from 2019 through 2021 today, and it ended up being $22.97. Now we have our actual dividend yields for QYLD. We have our average dividend yields using the 2019 through 2021. The percent is what it is on a monthly basis. So if you had $10,000, 0.93% of that would be $93. So if you wanted to withdraw your dividends for that first month, you would have gotten $93 in dividends. Let's see what our end result was. So 10 years into the future, remember the first 5 years are actual history, and then we forecast out using an average. So for QYLD, we end up having $26,500. And for RYLD, with those dividends reinvested, we would end up with $28,000. And the big reason for that is the average distribution yield is 0.93% per month versus 0.84% per month with QYLD. So all in all, even though there's less history, it does look like RYLD is providing a higher average dividend percent. And a big part of that is the previous year's performance. Now, one thing I want to point out though that I personally look at is the COVID drop. So during March of 2020, the price of QYLD dropped 22%, whereas RYLD dropped 43%. So your market value dropped twice as much if you had invested in RYLD. Now, everyone's risk tolerance is up to that individual, so maybe that doesn't scare you. But for me in particular, I definitely prefer QYLD just off of that information. So the next thing we're going to talk about briefly is investing in QYLD or RYLD on margin. Now, this is a bit more controversial, a bit more risky. However, it can be a good way to generate excess cash flow that you can use for whatever you like. So in this spreadsheet, we have QYLD and RYLD. We have our market value. So the market value is going to be whatever we borrowed. In this example, I did 50,000. We could change it to 100,000. We could change it to a million, whatever you want to put in there. And we initially purchase however many shares we can get at the time. So back 5 years ago, we would have been able to get 2,282 shares of QYLD, or we would have been able to get 2,176 shares of RYLD. Now, once again, this is an average because it wasn't around in 2016, but this is just for theoretical purposes. So this spreadsheet's a little bit different. The profit from margin is not the actual dividend. It is the dividend you would have received minus the cost of the money you borrowed. Now, this does not account for taxes. You still have to pay taxes on this money based on whether it's long-term capital gains, short-term capital gains, or if it's return of capital. That gets a lot more complex. However, the interest that you pay in margin is actually tax deductible, so that does help you a little bit. So looking at these spreadsheets, we borrowed 2,200 shares of QYLD, or we borrowed 2,176 shares of RYLD. This is the amount of money we would have gotten on a monthly basis that we could use to invest in other investments. We could use it to pay our utilities at our house. We could use it to pay a car payment, whatever fits your personal investment needs. So I just want to talk about a couple things real quick before we move on from this video. And one of them is that in my example where I was looking at our profit from margin, I used Robinhood's margin rate, so 2.5%. So you can borrow money from Robinhood for 2.5%. So you're basically taking out a loan and you're using that money to invest in whatever you like. For this example, we did QYLD or RYLD, and you're growing your portfolio's value by using someone else's money. Now, there's always going to be risk involved, so you're going to have to do the research to see if this fits your needs. However, the good news about QYLD and RYLD is they're considered low volatility, so your margin maintenance number, where you'd actually be margin called, is pretty low, which makes it a little bit less risky. One thing I did here is I made the example where if you've reinvested all of the dividends you made, so all of your profit, you put it back into purchasing shares. After 7 years and 7 months, you would pay back all of your QYLD margin. And after 7 years and 4 months, you would pay back all of your RYLD margin. Now to do that, you'd have to sell your shares, but at the end of that, you'd end up having all of that additional portfolio growth. So in summary, I think two funds are too close to one another to actually say one is better than the other. RYLD may be having a really great year, but what's to say that QYLD doesn't have a great year next year? I do think the volatility of RYLD is a little bit concerning. However, the best answer is just to diversify your portfolio. So if you can, have a little bit of RYLD, a little bit of QYLD, and then also have other ETFs as well. You don't want to put all your eggs in one basket. I think for someone that's retired or someone that needs that monthly income, these are excellent options. However, if you're not retired yet, you should probably be looking at growth ETFs instead of income ETFs because you don't need the money now. You don't want to worry about the taxes or anything else that comes along with that. My personal strategy, I do have QYLD, I do have NUSI, and a little bit of RYLD. However, this is just to replace my traditional bank account. I still keep money in the bank for certain occasions, such as vacations or home expenses, stuff like that. But in terms of an actual emergency fund, I did move the majority of that into an investment fund, which is 70% QYLD and 30% NUSI. That's just my strategy, which doesn't make it right for everyone. I do invest in QYLD and NUSI in margin, and that's another thing that I do with a little bit of risk. I just use the extra profits from that to fund more of my investments as well. Hopefully that works out for me in the long term, but only time is going to tell. So if you enjoyed the video or learned anything new, make sure you hit the like button, comment down below your thoughts. Let me know what you think of RYLD versus QYLD, and I hope to see you guys next week on Thursday. Thank you so much.